Welcome to the Contra Turtle Show. I'm a 38-year-old Singaporean 9 to 6 worker living in HDB, simple lifestyle with no car. Here, I share YouTube's most transparent stock portfolio, documenting my journey towards a 4.5 million retirement by age 50. I'm 4 years into the journey so far, with 12 more years to go and slightly under 4 million more to go to hit my target. Before I get started on this episode, a quick update that from now on, there will be an after show right at the end of every episode called The Naked Turtle, where I bear all my unfiltered naked thoughts on the current state of my portfolio and any interesting investment ideas, tech trends, news that I'm studying that is more suited for the serious investor. It's almost like a separate mini episode, so if you're interested, stick till the end. Anyway, back to this episode. In an earlier video titled Condos versus Stocks, I introduced a new movement called Go Ham, Not Glam. And the idea is to live in a simple HDB, treating homestay property as an expense instead of a capital tool, avoid cars and ridiculous COE to keep expenses low, market index invest long-term into assets like the S&P, and not to glam if you can't afford it because it's all great looks and all mortgage. In today's episode, I'm going to zoom into the controversial topic of car ownership and why regular Singaporeans like you and me actually have an unfair advantage over Mediacorp celebrities and social media influencers when it comes to building wealth for retirement. To understand why cars are such a hot topic, we have to start with a controversial piece of paper known as the COE, which stands for Certificate of Entitlement, a fee you need to pay the government before you can even own a car. Between 1975 and 1990, owing to rising affluence in Singapore, the car growth rate was nearly 12% per annum, and road tax alone was not enough to control the growth of cars. The government even tried something known as Area Licensing Scheme, or ALS, which is the previous version of our favorite ERP. People had to literally queue up at booths to buy an entry license to display on their cars before they could enter certain roads. Those were the good old days, and I'm sure some of you old birds can remember how troublesome that was. But despite all these measures, car ownership continued to soar, and there was a risk that our limited land for roads would result in unsustainable traffic conditions. So, the Public Works Department, or PWD for short, which is one of the Ahgongs of our LTA today, created a quota system to limit the number of cars on the roads, known as the COE. And so this system, combined with road tax, the ERP, and several other fees, continue to be how LTA controls the demand for cars and road traffic conditions in Singapore today. Throughout our history, the price of COE always fluctuated, reflecting supply and demand for cars. For example, at the end of 2008, following the global financial crisis, Singapore fell into recession and nobody was buying cars. Cat A COE dropped to as low as $2, cheaper than a plate of Mee Siam Mai Hum. Also, fun fact, the CEO of LTA at this point was Yam Army. Yes, it sounds familiar.
Pursuant to Section 49, subsection 7E, Paragraph A of the Parliamentary Elections Act, I declare Lee Hsien Loong.
Lunatic indeed are the prices of COE these days, where Cat A and Cat B have averaged from a ridiculous 80 to over 100k, making Singapore the most expensive place to own a car. Yet even with cost of living being a top concern with Singaporeans nowadays, this demand for cars reflected by the high COE prices does not seem to be going away. Now, I understand some of us really need to own a car. Like those with children or the elderly, taking public transport may be a nightmare, especially during peak hours. And even using Grab taxi is sometimes difficult because of the logistics involved, where you got lots of barang-barang and you're on a timer to board the taxi with all these young or old turtles of your family before you get slapped in the face with a waiting fee for taking too long to board. I understand, because I face this myself with a newborn baby. But what I want to call out is this obsession of cars as a status symbol instead of the utility reasons I've mentioned so far. This idea that when you earn a decent paycheck, you have to inflate your lifestyle and get a nice BMW or Mercedes like Zente Koko in order to prove that you are high SES. Now, I understand the allure of getting a Conti car, guys. I get it. It's like a shortcut to tell your family, your friends, people around you, what, Eh Sai Liao, I made it. I huat big already. And especially if you are a social media influencer or if you are a Mediacorp celebrity in Singapore, the need to look atas is even stronger. So it's very hard for these celebrities to stomach riding public transport with all the other regular Singaporeans like you and me. I mean, imagine if you are riding the MRT and you are seated next to influencers like Zente Koko or Mediacorp artists like Ian... Fuck, never mind. Better not talk about that one. But you get the point. And anyway, here's what I want to tell you guys. I'll tell you guys a funny story of a Mediacorp artist that I interacted with before. So he was actually the boyfriend of one of my childhood friends. And let's just call my childhood friend Angelina Jolie, who was also a Mediacorp artist. And then so let's call this a main character guy Brad Pitt, okay? Because he's really damn yen tao lah, like Brad Pitt in Fight Club lah. He was always wearing head-to-toe luxury clothes like Prada and all that. And then he used to go to this damn expensive gym that's closed now. It's the one with the window view of Orchard Road. And he actually invited me once to join him for free. And he spent damn a lot on all those expensive protein shakes and all this luxury wear. And all his photos in the media, all the photos, they look damn atas one. So I always thought, wow, this Brad Pitt buay pai leh. Mediacorp artist, yen tao and quite rich. But once, when we were at Balestier Road and he needed to go to Orchard to gym, Angelina Jolie had to rush somewhere else and couldn't give Brad Pitt a lift on her car. So I asked him, why don't you take a taxi lah? Then he said, I cannot afford, never mind, I will walk to Orchard. Then I said, Orchard is damn far leh. Why don't you take a bus or MRT? And he refused because apparently someone of his stature was not supposed to be seen on public transport. And then he said, anyway, I walk like this far every day lah. And that is when it dawned on me, guys, there is actually a look rich hack in Singapore. If you cannot afford a car and you need to get from point A to point B, and that is to walk everywhere in Singapore. Because while you're walking on the road, nobody can tell if you are rich or poor. They don't know if you have a car or not. Because remember, even a billionaire needs to walk on the streets at some point. And so if you're used to this idea that the social status of the car that you own is tied to your identity, yet you want to gradually embrace a more frugal life to build for retirement, then my suggestion to you is to abuse this hack and walk everywhere in Singapore so that you can slowly get rid of this feeling of low SES or insecurity until you are ready to take public transport. But if you live in Jurong and you need to go Changi, then good luck to you lah. By the way guys, if you like the content so far, remember to give the channel a bit of turtle power and click subscribe so you can be informed when I push out new content. Feel free to leave a comment below and I'll try to read it. Some of you left me great comments like this one over here. I really appreciate it. And I also have a Twitter account, which is where I share more technical stuff about technology or the markets. And my Instagram is where I post light-hearted slice of life stuff as I work towards my retirement goal. Anyway, back to the episode. Jokes aside, the reason why I brought up this story is because regular Singaporeans like you and me have an advantage. There is no need for us to keep up with appearances and we can take the MRT whenever we want. And of course, us and when we need to, we can take the taxi. All this cash flow that we save from expensive Conti cars, ridiculous COE, road tax and parking can be freed to be deployed to a broadly diversified market index like the S&P 500 to compound your wealth long-term for retirement. So the average Singaporean can actually build wealth faster than the average Mediacorp celebrity because you do not have the shackles of social status, where the opportunity cost of owning a car instead of investing is substantial. And I don't buy the argument that if you work in a certain line like insurance agent or real estate agent, financial advisor, then you must own an expensive Conti car just so that you look rich and then you can impress your potential clients and all that stuff. Then you can close the deal, even if it means overstretching your financials. I mean, look at successful Singaporeans who have sold their car to declutter their life, like Christopher Tan, CEO of Provident. He has $1.4 billion of assets under management in his company. Or Adam Khoo, with a stock portfolio of $18 million and above. Or millionaires like Mr. Lu or 1M65, who drives a simple Japanese car focusing on utility over luxury. worry. All of them understand the opportunity cost of investing if you own an expensive Continental car. Real successful people don't need to prove anything to anyone. Don't let a car define who you are. Work hard and let your reputation precede you. Don't be a sesame ball like my friend Brad Pitt, rich and shiny looking on the outside, but inside lao hong with only a poor amount of sesame paste. Hope you enjoyed this episode. Remember, if you ham today, you will what at retirement. Thank you for watching, everyone. Alright guys, we come to this Aftershow section, which is a new one that I've added. I call it the Naked Turtle, where I have like portfolio updates and news. Before I get started, I just want to say this is not financial advice. It's just my unfiltered thoughts. You know, there's no editing, no fancy turtle images or cute stuff or memes. It's just what I think about the state of the market, my portfolio and recent news and stuff like that. It's more for the serious people because I know there's really two sides to my channel actually that I try to tackle every episode. One side is all the social, personal finance issues that are very common in our Singapore mindshare, and the other side is I'm very passionate about investing, analyzing businesses and so on. And I keep thinking, how can I show both sides right in one episode? So this is the only way I can figure it out. It's a mini episode after all the fun stuff lah. So if you stay until here, it means that you're pretty serious and you kind of want to know what's in my mind and I'm thinking. So this is my portfolio. It's 543k. I've been invested for about 4 years now. It's done pretty well. Some people ask me for receipts because they don't believe, because I use this tool called Portsedo. The Portsedo actually consolidates my 3 brokers that I have. From the left to the right, it's the biggest one I have is Tiger. That's about 300 and something k, 370k Sing dollars. The middle one is IBKR, 150 plus k, and then the third one on the right is Momo, which is my smallest. You can ignore all those positions with like only one share lah. Those are just free gifts from all these brokers that I don't consider as part of my core. So when I consolidate it into my Portsedo, it doesn't reflect there. So for the regular followers who follow my show every week, I don't want you all to think that when I show this page here, which is the returns, the time-weighted returns, that I care about the returns every week. Then I very kanchong, then I keep looking. That's actually not the case. Actually, when I show this, it's more for the new viewers who maybe they come in and look at it for the first time. They want to know transparently, hey, what is this turtle performance, Because I always believe that when we always listen to all these gurus and investors and stuff, they talk a lot, but it's very rare that some of them actually show their full portfolio, individual performance, and then their CAGR over time. They don't really show their transactions. And I want to break that convention and be like the first YouTuber that shows everything, all the receipts. And I promise you, even when it's down, even when my portfolio is down, you will get to see when it's down. And I mean really down. Like if it can go down 50, 60, 70%, it doesn't matter. I will show you the losses. I have some episodes in the past I released. There was one called something like losing $105,000. There was a point in time when I think it was during Liberation Day, Trump announced all the rubbish tariffs and my portfolio went down like 20%. So it went down like 100 plus K. I showed those, and my portfolio is not perfect. I got people who will criticize me. I got all this. A lot of people are asking me, "Oh, your Sharpe ratio very high and stuff like that." That's why I want to emphasize firstly that this is not financial advice. If you're starting out investing and you don't know much about individual company picking, my advice is don't do it. And it's important that you don't copy or what we call coattail investing, which is just to wholesale copy like what I do or what people are doing or Warren Buffett or whatever. You read their 13F and then you just copy wholesale. Why? Because there are 3 reasons. I always tell people. The first reason is that, yes, you may know the companies that I own now. Yeah, it looks perform very well, but you may not be getting the prices that I got, the valuation. So your future performance may not be the same. And then the second reason is that when the stock falls, which it will, I can guarantee you, and in this long-term business or investing, if there's one certainty I can guarantee you, it's not that you will make money tomorrow, it's that you will definitely lose money along the way, 100%. And I don't mean lose money in terms of realized gains. Obviously, your position, you're long-term invested, you don't sell your positions because your thesis is long-term. There will come times when your stock drops 10%, 20%, 30%, sometimes even 80%. Like what happened to Meta back in the early 2020s or 21, 22, all right? The period when the metaverse overspending, all that stuff, right? And it's at those moments, right, when the companies you buy, right, if you just copy, right, what are you going to do at this point? Are you going to wait for the 13F of the super gurus you try to follow? Or are you trying to wait for Contra Turtle? I mean, I'm not a guru. And then ask me what you're going to do. You have to form your own conviction and your thesis. Right? You can be inspired and you go and do your own work and your own research. Right? But if all of this is too difficult or it's too much hassle or your day job takes out a lot of time, my suggestion to you is very simple. Not financial advice, but in general, look at broadly diversified index like the S&P 500, right? And play the long game, 15, 20 years and beyond. Don't need to rush, guys. This is not 4D. And then look at the returns. You slowly compound, right? Mr. Lu at 1M65 always says use a calculator. Press, for example, 6%, 1.06 to the power of n number of years. Let's say 15 years. It's a very big number. And then you multiply that by your starting capital. Don't be greedy and, be patient and play the long game. But a lot of it is also about cash flow and expense control, which is one of the reasons why I put the front of the episode a lot about this social, personal finance issues. So anyway, coming back to this, I think there was a third reason. I forgot why you shouldn't copy, but you guys get the drift. Don't copy people when you guys invest, okay? My performance year to date has been 15.6%. A lot of it really has been, later I'll talk about the positions. The earnings have been very good. Versus the SPY and QQQ, I've far outperformed them by almost close to 18-19%. But again, these 3Ds are all entertainment. 4 years into investing, I don't see any conclusive result to say that, Contra Turtle is a great investor. No, we must always look at least 10 years, more than one market down cycle, right? I've only gone through one cycle, which is the Fed rate hikes in 2022. So we don't know whether I'm good yet. So don't just treat this all as entertainment. So this is all in the spirit of transparency. The annualized returns over the last 4 years, 22%, 22.95 versus SPY QQ I beat. And then this one, sure some of you are interested, like my actual positions I hold. Yes, I only hold 5 positions. If you looked at some of my past episodes, you'll know that I study all the businesses on my watch list very, very intensively. Do not follow what I do. It's very high volatility. I even know what color underwear Mark Zuckerberg or Rick Smith or Ahgong is wearing. That's how detailed I am in investigating my companies and monitoring. And I do have a couple of companies on my watch list, but very similar to Charlie Munger, Dev Kantasaria, or Lilu, or even recently I found out Chris Horn, right, who is the manager of TCI Fund, right? Really impressive long-term investors. They all have positions less than 10 positions. And I'm very inspired by that because I'm the kind of guy that doesn't like to do scatter shots. I have a friend who I'll be doing an interview next week's episode. He runs a fund, and him and a few of my friends, they have a larger number of positions, I think like 40 or 50. And they prefer to spread their seats. So, everyone has a different style. But my philosophy is very sniper-like. So, yeah, it's just the style that I invest. But just running through real quickly on my positions. So, at least in my opinion, I feel like at this moment, juncture, Meta and Amazon, valuation-wise, probably still makes sense to buy at this moment. But later you'll see, I'll even show you my transaction logs. I typically only buy on pessimism. So even though they are valued pretty well now, I am not buying now, even though I'm getting my salary tomorrow. Yay, very good. Every month I get salary, right? I'm just a regular guy like you guys, earning money, right? But I probably will not be plowing anything in the market because I only buy on bad news and pessimism, and unjustified pessimism to be specific, or like sudden huge macro dips, like what happened during the Trump Liberation Day thing. Because what I find is that when those things happen, right, naturally the valuations will just get to the level that you need them to get to, whether it's on a free cash flow basis, whatever PE ratio, coupled with, some people like to use technical analysis. I use a little bit just for psychological reasons. I think there's some factor, but it's a very small percentage. I'm still mostly a 95% a fundamental investor. Bottoms up. So I think at this moment, Meta and Amazon probably, but I wouldn't buy, at least not for me, because of my style of buying the pessimism. And you can see like the gains have been pretty decent. Especially in Q1, all the earnings did very well. Even Amazon did pretty decent. But the only thing was that because it was pretty much in the epicenter of the whole Trump trade war thing, and people have the impression that the whole China supply chain would affect the prices of Amazon, which is false. If you actually go and study the business, it's actually better for Amazon, especially the de minimis rule has been removed, right? It actually means that players like Shein and all those are the ones that are going to die out. But yeah, that's Amazon. It's probably the only one that's sort of lagging in terms of closing out the gap to its valuation, in terms of price. So apart from these 5 positions that I actually have on my watch list at the top, I think some of you know Hermes is at the top of my watch list. Booking as well. Hermes is probably priority number 1 for me, but I haven't been able to find good valuation entries. I'm very sad because a couple of months ago, when Trump started the Liberation Day thing, there was this, I don't know if you guys know, there was this TikTok campaign that went about. Obviously, I'm not going to point fingers and speculate what entity or who started this campaign, but there was this whole campaign about factories in China producing a lot of the luxury goods, including Hermes. And I'm quite addicted to TikTok because I do it also because of research for Meta lah. So I make myself scroll TikTok every day, not really just for entertainment, but just to see what competitors my Meta position is up against on a daily basis. Right? I just want to know the quality of reels and what's going on, the trends with young people. They have a pulse on the ground. But as I was scrolling during that time 3 months ago, there was this huge campaign where they said that Hermes actually, most of the parts to manufacture a handbag and all those accessories are mostly done in China. And only the finishing touches are done in France. So basically the campaign on TikTok was trying to diminish the luxury factor and image of Hermes. And every day, right, after this campaign went on and on, right? So this campaign was obviously to prove to the world that you need China, and China is the real factory behind the world, and it's supposed to be in your face thing to Trump lah. Every day I was waiting for Hermes to drop, but it just would not drop. So I've been waiting for years already, and I thought finally can get, but still cannot get. I mean, if it's gonna be a few more years, so be it lah. Right? This is investing. You have to be patient. So I almost always buy only on pessimism, even if it takes me years. You know what Warren Buffett always says, right? Be greedy when others are fearful. Be fearful when others are greedy. And I really take that to heart. And one other thing I want to note is that for me, the way that I manage portfolio is that I hope that Hermes falls on its own due to its own individual bad news and bad earnings in any one quarter. I mean, the reason for that is because there's actually an opportunity cost of capital if the wider market falls together. And I'm compelled to choose between faster growing growth tech names like Meta and Ahgong versus more mature cash flow generative companies like Hermes. Because in the long scheme of time, okay, if we look at the fundamentals, not the price action, guys, the fundamentals like the revenue, etc., the revenue growth of Meta and Ahgong and the catalysts that are inherent in their, if you've been following their news, they have a lot of catalysts that are coming up, right? It's more explosive. So in the long scheme of things, there is an opportunity cost. If all the market goes down, Hermes goes down, Meta goes down, Ahgong goes down, all these companies in my tier 1 portfolio that you see on my screen goes down, I would always prioritize the top 5. But if Hermes falls down out of sync by itself, that's great. Because that means that the rest of these companies, they're already at maybe high valuations. And then if I have excess capital that comes in every month of my salary, I deploy to this Hermes. So I mitigate some of the potential opportunity costs of a slower growing company like Hermes versus all these higher growing companies. So I don't know if this makes sense to you, but these are things that are running through my head every time I deploy capital. I think very, very carefully. If you look at this, so this is the first time I'm actually showing to you guys. I've only done 62 trades since the beginning of time that I started this inception. Very little. And if you look at the flags, are all Bs on, they're all buys. Why? Because I'm a long-term investor. I don't believe in selling, even if it's overvalued in the short term. Most people, right, they do this thing called trimming. You hear this very common word, trimming. What they do is that when a stock, for example, like Netflix, my Netflix stock has tripled. It's nearly 3-bagger already over the course of the last few years. I haven't sold a single Netflix stock except for one on the screen you can see here. Why? Because fundamentally, I discovered Ahgong as a company, and I felt that the fundamentals of Ahgong grow faster than Netflix on the long-term horizon. So that's only reason I would sell a stock, or I'll sell a stock if I need the cash. I will never trim a stock as a reason for selling when a stock like Netflix is tripled and there's no other opportunities for capital allocation. And you want to trim it. Some people say I want to trim it and take some profit off the table lah, so it's safer. But you have to understand that my investment horizon is not 1 year, 2 years, or even 5 years, guys. It's really 10, 15, and even 20 years and beyond. I'm 4 years in, I have 12 more years to go. So my investing horizon is like 16 to 20 years actually. So I'm really more interested in the price of Netflix at the 15, 20 year mark, not the 5 year mark. So why should I sell today after 1 to 2 years in order to optimize my 5-year CAGR at the expense of my 10, 15, and 20 year CAGR? And this is the illusion of it's a very difficult thing for a lot of investors to grasp, I feel. This kind of short-term trimming mentality. But I don't know if you understand what I just said. Hopefully it makes sense. So you can see, right, I only buy into pessimism. And I haven't, if you look at the top of the buys here, I only bought the last one on the 17th of April. That's nearly a month ago already. When Meta, following the Liberation Day rubbish that Trump did, I saw an opportunity. It was like, went all the way down to 497. sometimes even lower than that. It was like 450, but you cannot catch the bottom. Somewhere around the bottom is great enough. And I bought in, right? So that's buying into pessimism. And ever since then, I cannot find any opportunities to deploy capital that fits my philosophy of buying into pessimism on good, high quality companies that can have durable moats for the long term. Obviously, that's the first criteria, right? Because remember, cheap shit is still shit, huh? So valuation is actually, even though I talk so much about valuation now, right? Valuation is the last of my criteria. It comes way after everything else, which is things like pricing power, durable moat, the management, how good they are, stuff like that. I had an earlier video, like you just got to go and look at it. I have sort of like an 8-step criteria that I go through before I even invest. And obviously it has to be within my circle of competence. Companies that, are in the industry that I work in, which is tech, right? Hermes is another story lah, okay? I'll tell you all the truth one day why I am so familiar with Hermes and some luxury brands, all right? The source is just you gotta trust me, bro, that I know the industry. So anyway, there's a high chance I will begin storing more and more dry powder. There's really nothing to buy for me now. The market is very bullish. I'm someone who hates crowds. I am contrarian, which by the way is the longer form of contra turtle. It's contrarian turtle, not contra trading turtle, which some of you think I don't do short-term stuff. So I tend to move opposite from everybody else, right? A lot of people now are very optimistic. Oh, we got a taco treat coming with Trump. Taco stands for Trump always chicken out, everyone's very optimistic now, but no, I always go the opposite way. Nvidia released their earnings. They performed Q1 pretty well in spite of China curbs. The market seems to like what they see with the earnings report. It was just released early this morning. Post-market action seems to be above more than 5% already on the price. And I mean, if you've been following the market, Nvidia is literally the bellwether of the entire AI movement now, right? If you look at the last few days, right, and you actually look at the price action of the market, right, especially for the Max 7 or the general tech or even just the general market, right, the price hardly moved, really, last few days. Everybody is just waiting for the Nvidia announcement, the earnings. It's almost like waiting for the Fed already at this point. The entire market will follow. So right now the market is really quite ready when I look at it now. So at this point, I'm not saying there's an AI bubble, by the way. I'm invested in some of these stocks that are AI. Some of the semi-com people gonna whack me here. But if there is, I'm just saying if there is an AI bubble, Nvidia would obviously be the canary in the coal mine. Okay, it's just something to watch out for in the earnings. So if the earnings even takes a dip in a single quarter and it's serious, hongkan already. I sent a tweet a couple of days ago. I think some of the followers followed me. I was talking about the AI glasses and I did this cheeky thing when I tag all the CEOs. I know that nobody gives a shit about me lah, just a small-time investor. But I noticed that increasingly a lot of big tech is going into the glasses market, right? Even after the failures of Google glasses earlier in the years, Sergey came out in an interview recently on the Google I/O conference. He talked about he was asked what are the failures that you learned from the Google glasses, right? And he said that he felt that the technology wasn't there, which today is actually, we can see is kind of makes sense now because of Gen AI and all the developments. And number two, he said that he realized that at the time when Google glasses came out, the thing is they underestimated the manufacturing requirements to make Google glasses, so they failed on the supply chain front. So which is now why with Android XR, which is what Google is launching, right? They solved the technology piece with Gemini, which is their LLM, obviously, their transformer model. And also they are partnering with was it Samsung and Qualcomm or something, but they have manufacturing supply chain partners this time. They're not going to pao ka liao now. Now what's the point of me talking about all of this? Google is doing Android XR. And Sam Altman and Johnny Ive, OpenAI just did the acqui-hire, right? They got Johnny Ive's company for like 6 point something billion. They are making a product, AI product. It's going to be a new computing platform. My guess is that platform has to be glasses. There'll be a lot of theories that they are going to do this humane pin thing where they pin it on the t-shirt. I don't think so. I really think the next computing platform will be glasses. And I'll tell you why it makes the most sense. It's actually after I watched an interview where Mark Zuckerberg was talking about the Orion glasses. Right, the interviewer asked him why he felt that glasses is the best next form factor for the next computing platform after mobile phones. And he said, I remember very clearly, that it's intuitive to keep looking up and engage with the world. The glasses see what you see, they hear what you hear, and they're constantly passing the world as what you pass the world. When I say parse, I mean P-A-R-S-E. It's a tech term that we use in technology field. If you're an engineer, you will know what I mean. And also there's this idea Zuck was saying that you project AR into your glasses, right? And the key here is, if you guys know Zuckerberg, he's a guy that really focuses on the social elements of the world. That's why he built Facebook and all these things. The key thing that convinced me was he said, the sentence was, he said, you should no longer need to look down at your phones. You can remain looking up naturally while interacting with the world and the people around you as you walk around in a social, normal human manner. When I heard that, right, it made so much sense to me. It's so intuitive. And I feel that that has to be the next platform. It cannot be the humane pin form factor. And which is why, right, there are already rumors going around that Apple is working in secret on a similar product, because they are more, the heavy, what's that vision, the VR thing that they did? It's so cui that I can't remember. Is it Vision Pro? It didn't take off. If I recall correctly, the last time it's had any product market fit was in the enterprise, only enterprise market only. They probably use it to do some very niche enterprise cases. So there were rumors that Apple is actually also working on this, right? But I have some theories on that lah. I wrote here in the tweet that Apple has to leverage their privacy play, because if you think about it with glasses, right, there is one problem which maybe Zuck also has thought about it, which is it's not great because Meta is known to be this thing that invades your privacy, right? Which is that if you have a glasses, right, your glasses is always on. So there was a Black Mirror episode, if you guys watch on Netflix, right, where if you have glasses or this electronic eyeball that records everything you see, right, it's very invasive on people's privacy. So I think there will be some social regulatory pushbacks on that front. But I think Apple is in a good position to overcome those barriers because of Tim Cook's whole focus on privacy and the huge battle against Meta. Zuck is willing to risk it all, as he has done with the metaverse before, and he's willing to be wrong. It's the point I'm trying to make. I do not think that the other companies are as willing as him to be wrong and to take a bet like this. You need CEOs, right, at this kind of inflection point, right, where this is going to be the next computing platform, right, to be daring to take that bet. And it's not like it's going to be a risky bet. Okay, if you've been studying the financials of Meta, right, despite the cash burn that they had with Reality Labs division, they have maintained an operating margin of 40%, which is insane. So all it needs is RL, the RL division, to generate any kind of positive cash flow, positive profits, right? It will tremendously lift up the already high profits of the rest of the Meta business, which is the ads business, which is like printing money at the moment. The reason why Meta is my highest position, right, is because there are tailwinds, in my opinion, for the short, medium, and the long term. In the short to medium term, the social network of Meta is a huge moat, right? The whole black box and advertising model. And I have a thesis in the short, medium term also that actually media assets are a natural beneficiary for the current Gen AI wave. Why? Because images and video generation for ads will have lower cost basis of production, expanding the earnings per share. If you guys follow some of the AI stuff, media, people create a lot of creative things. I mean, even my channel, right? I use GPT to create all this media, right? Gone are the days where I need to hire a $60 graphic designer to go back and forth, and each iteration maybe charge me $5, that kind of thing. The cycle of producing media assets is getting faster and faster with Gen AI. And I believe that a lot of this will flow naturally into Meta as a company that deals so much with advertising assets like media and have this very virtual cycle of expanding their EPS. And actually, I have a similar thesis for Netflix also. Even though Ted Sarando's claims, I mean, you look at his last two earnings calls, I watched all their earnings calls. He says that it's not about using Gen AI to save money. It's about using Gen AI when needed to make the best possible films. Yeah lah, sure lah. But you can also save money while doing that, right? I think that's the point he's trying to make. The Americans are like that one. They will always sell the value proposition, and then they won't really go into the weeds of things and say all this like they will sell a dream lah, right? So, and it will be a very classy sounding dream. It wouldn't be like, oh, we want to use Gen AI to save money. That's a bit more like I don't want to offend anybody, a bit more like the China style. Okay, it's not that it's good or bad. It's just a different style. But the Americans are more like they will sell you the positive dream, and then they won't talk about all this. Things that have negative connotations, like, oh, you're building cheap stuff with the Gen AI and all. So I think he's just downplaying that. I really believe that they will expand EPS also for Netflix because of this natural thing where Gen AI, by virtue of the transformer architecture, if you guys know how LLM actually works, next token prediction, there's a lot of, I see a lot of hallucination, I kind of whack also. There is some hallucination which will never go away because it's inherent in transformer architecture, okay? And when you're dealing with media assets and creativity, as I'm doing with my channel, hallucination is a feature. It's not a bug, right? If you're in tech, you understand these terms. Because the more hallucination there is, the more creative my media outputs, like my image and videos, are. And so what happens is that you get even more creative advertising, even more creative, B-roll videos and film footage for Netflix to produce your films and your movies. And that creates a lot of virtual cycle to build more and more of this stuff. So, this is the reason why Netflix and Meta have such a huge part of my portfolio. I believe it's riding on the tailwind of being the direct low-hanging fruit beneficiary of this whole Gen AI cycle. But yeah, I've gone a very long way sidetrack into a very deep rabbit hole, but I'll just come out of it. So anyway, this is just a very quick after-show update. I sincerely believe that Meta over the next 15 to 20 years will be the most valuable company in the world. But yeah, I'll try to do a deeper one next time. I don't know if this is deep enough. Anyway, that's all, folks.